Good afternoon, everyone. My name is Luke Tannen, and I'm the Executive Director of Chicago Innovation, an organization that supports local innovators and entrepreneurs across industries, big companies and startups through a variety of events and programs. We are also a very proud partner and customer of Wintrust. And on behalf of Wintrust, I'd like to welcome you all to the third installment of Wintrust Wealth Management's panel discussion series on the economy and financial markets. During today's event, the Economic Recovery and You, our speakers will cover the economy and the investing landscape in light of the presidential and congressional election outcomes, proposed tax and fiscal stimulus plans, and the latest developments with the ongoing pandemic. Now, before I introduce today's speakers, I'd like to let everyone know that if you have a question, you can send it to us via the Zoom Q&A while the event is taking place, so our speakers can see what is on your mind and try to respond to it. Also, keep an eye out for a few polling questions so we can learn more about your own perspectives as well. Our moderator for today's discussion is Tom Zidar. Tom serves as chairman and CEO of Wintrust Wealth Management, which manages or administers $32 billion in client assets across 4 operating business units: asset management, trusts, investments, and 1031 exchange. Tom is in his 15th year with Wintrust. He joined the company after a long career in financial services that included investment banking, management consulting, and then 9 years with ABN AMRO's LaSalle Bank right here in Chicago. Our panelists include Jason Turner, who is the head of multi-asset strategy for Wintrust Asset Management Group and is a member of the firm's investment committee. He is primarily focused on interpreting economic and market conditions to create investment solutions and strategies for institutional and individual client portfolios. Jason's also a regular guest on WGN's Business Lunch Hour radio program and does frequent public speaking engagements on the markets and economy, including recent presentations to the American Diabetes Association, the Illinois Restaurant Association, and the Florida Public Pension Trustees Association. And then also on our panel today is Dan Rahill. He's the managing director and a resident tax expert with Wintrust Wealth Management. Dan is often published and quoted in media outlets, including the Chicago Tribune, Crane Chicago Business, ABC7 TV, and Yahoo Finance, as well as the Illinois CPA Society's Insight magazine. Dan's a former chairman of the Illinois CPA Society and serves on 3 academic advisory boards and several nonprofit boards and committees. We've got a great group today, as we always do. And with that, I will turn things over to you, Tom.
Great. Thank you, Luke, and welcome everybody. We have a lot to cover this afternoon. So Jason, let's start with a recap of the economy in the first quarter. How have things gone both in absolute terms and relative to expectations at the start of the year?
I think we go back to those expectations at the start of the year, and we expected growth to slow a little bit from the fourth quarter to where we were going to start the year in the first quarter. Going back to January, that estimate for GDP growth was about 2.2% on an annualized basis in the first quarter. Since then, and we've seen a real resurgence in things like retail sales in the month of March in particular. A faster vaccine rollout has contributed to a faster economic recovery, and we're now seeing estimates for the first quarter topping 5.6%, which is more than double the estimate for economic growth on an annualized basis in the first quarter. That's also pushed up estimates for the rest of the year, particularly in the second quarter, as we see some of those anticipated second half of the year spending items kind of push up into the second quarter. And even the Fed has raised their full year expectation for GDP growth for 2021 north of 6%. The Wall Street Journal Dow Jones poll puts professional economists at 6.4% currently for 2021 growth. That would make this the best year for economic growth in 40 years. The unemployment picture has seemed to be improving. Most recently, we've seen 2 weeks now of declines in the initial jobless claims. Those weekly claims against the headline number show continued improvement from our drop to 6% on the headline number. The stage is really being set right here for a jobs recovery running into the end of the year, particularly into the last 2 quarters of this year.
Yeah, thanks, Jason. Can you touch on a couple of hot topics of late? Inflation, and then, of course, the housing market.
Of course. In the inflation area, we saw for the first time in the headline inflation report a couple of weeks ago what the Fed has been telegraphing in terms of base effects. What they mean is by base effects, we had 3 months of price deflation last year. As the economy shut down, as we saw the COVID pandemic initial response deployed, we had price deflation. And those are rolling out now of the 12-month comparable numbers. So we saw a stair step up in inflation numbers on the headline basis a couple of weeks ago, also spurred by energy prices to 2.6%. If we factor those out, those energy prices out, and look only at core inflation, it's still up only 1.5% from where we were over the course of the last 12 months. We expect over the next 2 months to see more of those base effects work their way through that number, likely taking that core inflation number north of 2.5% on a headline basis, potentially even above 3%, with some leveling off from there. We're going to be watching infrastructure and Fed bond purchases very closely as we look at what the inflationary impacts and reactions are going to be. You also mentioned housing. For housing, things have slowed in recent months. We certainly saw a winter slowdown, weather related, particularly in the southern states. They've been slow to recover from a housing perspective. We're likely also seeing some effects from the winter COVID surge, slowing buying activity down a bit. We're still anticipating a return of sellers to the marketplace. That's been a big supply and demand imbalance there, with home stock at its historic lows, less than 2 months of stock of existing homes for sale late last year. That normal number would be closer to 6 months. So as sellers come back to the market, I think that starts to cool the new home sales market a little bit into the summer. Existing home sales should pick up, and we should work out some of these supply and demand imbalances in the housing market from there.
Yeah, thanks, Jason. You know, it's been a record origination, probably 4 quarters in a row now for our Wintrust Mortgage Group. And despite the tight housing supply, as you note, and rates coming up a little bit of late, but so our team still looks for big numbers throughout the summer months. So I think more to come on the housing front. Well, let's shift gears to the markets. While the markets have pulled back today a bit, it was another really good quarter for stocks. Jason, can you give us some of the highlights?
Yeah, sure. As you mentioned, equities definitely had a strong quarter. The S&P 500 was up 6.2% for the quarter. The Dow was actually up 8.3%. The story behind those returns is something we've talked about at each of our last 2 panel discussions, going even back to last fall. And that's the idea of a rotation from large cap growth stocks into smaller cap stocks and value oriented stocks, really driving performance. At a sector level, you can see that varied performance as things like energy, which was up nearly 31% in the quarter on strong oil prices, but also financial services, industrials, material stocks. Those all came up significantly in the quarter, driven by that rotation into more traditional old economy or value stocks. Things that trailed, like technology and consumer discretionary, have really led the market for 13 months. So that rotation was maybe long overdue, and it's kind of persisted from November forward. We've also seen a run up in rates, as you alluded to, Tom, with treasury markets reacting to inflationary fears. We seem at this point to have settled into a bit of a stable trading range for now. And I say for now because as more economic results come, we expect those rates to drift higher towards the end of the year.
Yeah, understood, Jason. You know, with some strong, obviously strong markets, and in some cases record-setting performances in certain indices in the last 12 months or so, talk has picked up of late of overvaluation or market bubbles. How do you feel the market is valued today?
When we talk about market valuation, we talk about that through a number of different lenses. And equity markets in particular, large cap US equities, appear overvalued using a traditional price to earnings multiple, or even Professor Shiller's cyclically adjusted price earnings multiple. We can even extend that to the Buffett indicator. This has received a bit of press in the last couple of weeks. That's the idea of total market cap over GDP, Warren Buffett's preferred measure of valuation over valuation. And even that metric shows that stocks right now on a consolidated index basis are significantly overvalued. However, with the uneven performance we've seen over the last 12 to 14 months, particularly across global equity markets, I think it's fair to call, it's not necessarily fair to call all global equity markets overvalued, even if large cap US growth stocks are. And while there's certain market sectors and geographies and even individual industries that have certainly run considerably, think the work from home stocks, for example, there are many others that have reasonable valuations at this point, particularly with low rates. It's also worth noting that those low rates in our current environment and the Fed's commitment, as they've come out in the last couple of weeks to get behind that commitment yet again, it means that some other indicators of valuation, such as earnings yield of the index versus the 10-year bond yield, actually shows that there's some space yet to run for equities, even at these levels.
Okay. Great. Let's switch topics now and talk about our ongoing battle with this pandemic. And let's start with the first question to the audience here concerning the return to work process. Okay, thanks, Paul. It's up. The question number one is, what do you expect a new normal to look like in terms of people coming back to the office? And we're going to measure this by fall of this year. So the range is 100% back to normal by the fall. And you can see, we're talking about, 4 or 5 days a month where people are still largely working, a little bit from home, roughly half time at home, mostly working from home, or same as we are right now. Those are our, 5 options. So take a moment, please, to answer the polling question, and we'll come back to it in a minute. And I'm going to do that myself. Okay. Okay, so Jason, you tell us, where do things stand in the U.S. in terms of the pandemic?
Here in the U.S., I already mentioned we saw a bit of a surge, nearly 250,000 cases a day on a trailing 7-day average at the peak of the winter surge. We've seen that abate to a large degree, and the trailing average of cases has fallen back to levels we haven't seen since last November. There are some new variants that have popped up here in the United States, particularly the UK and what's being called the New York variants. Both of those appear to be starting to push infection rates higher again in a few specific states, although it's not yet anywhere near the same scale or volatility that we saw in December. Globally, though, the story is a lot more troubling, as case growth, particularly in India, has now passed the worst levels seen during that US surge, now north of 275,000 cases a day on a trailing 7-day average. And Brazil continues to struggle with a virus containment issue, but also its own mutated strain that seems to behave in many respects like these UK and New York variants that tend to be more infectious, particularly for younger folks.
So, Jason, how are we doing on the vaccine front?
That's been actually a big plus, both in terms of economic results, but also in terms of the human toll of this pandemic. The US vaccine rollout has gone faster than forecast had even hoped for. We're now at nearly 40% of the total US population, and more than 50% of those that have actually been eligible to get a vaccine, having received at least one dose. Nearly 25% have received their second dose. At our current pace, we're on track to have 90% of Americans, total population, vaccinated by late July. However, other than Israel, the UK, and Chile, the rest of the world is not tracking this progress. Europe has struggled with vaccine rollout issues. They actually got started a little faster than we did and have had a much slower rollout. They've run into problems with the AstraZeneca and Johnson & Johnson vaccines. They were their 2 primary tools. They're solving that. Those outbreaks I mentioned in India and Brazil are troubling because their vaccination rates are very, very low. In India, it's only 1.4%. Globally, we're at 6.4% of the global population vaccinated at this point. The Fed has even made it a point to say that challenges with future vaccine spread globally are the greatest risk to economic growth and stability going forward. So we've got to keep a clear eye on this going forward.
Absolutely. Okay, before we move forward, let's see if we can get the results, Paul, from our first polling question. Okay, interesting. So it looks like almost a split, let's see, almost 80% of the votes for some time for employees working from home, so 4 to 5 days a month to half time by the fall, which I think is encouraging from our audience anyway, that we're going to get back to some kind of a new normal here in the coming months. All right, I can close that for us. Okay, so Jason, given all of this, what are your thoughts on the economic impact of the pandemic in the next several months here?
Provided we stay on the same pace of vaccination and we don't see a resurgence in COVID infections, we're on track, as I mentioned earlier, for 2021 to be the best year for economic growth in almost 40 years. We have to go back to the early 1980s, the Reagan years, to see economic growth like we're going to experience towards the back end of this year. As the virus continues to become less of a concern, I'll go back to this idea of consumer confidence improving as the key to unlocking that economic growth that I've been talking about for months. Combining that with the high current savings rate, a confident consumer plus a lot of money to spend either from stimulus or from just savings that they've deferred or forestalled spending, the increase in that confidence should lead to robust consumer spending throughout the rest of the year. And again, consumer spending drives 70% of the American economy. So the growth over the latter half of the year, particularly in the United States, should see the U.S. lead the globe in terms of global growth. That'll start to shift as we get into 2022 and 2023. But for this year, America's kind of resuming its role as global growth leader.
Okay, great. Thank you, Jason. Let's switch our focus to Washington and fiscal stimulus. Dan, the $1.9 trillion American Rescue Plan was signed back in March by President Biden. It's an enormous funding package. Where is that funding going?
Well, Tom, it went to a very broad range of recipients, and you're going to see a chart in front of you right now showing where the $1.9 trillion went. I want to point out just a few specific areas that will be of interest of our Wintrust business clients. $7.25 billion going to the Paycheck Protection Plan that's been extended through May 31st now. A new one, $28.6 billion in restaurant revitalization grants, and what I call the hidden gem of the last year of stimulus, the employee retention credits. That's been extended through the end of the year as well. And not last but not least, I just want to say what's gotten the most publicity are the $1,400 stimulus checks that came along when Biden signed the program, as well as increased child care credits. And you'll remember in our last program, we said this act would be signed before March 14th. Why? Because that's when federal unemployment insurance benefits would run out. Well, it was signed before March 14th, and federal unemployment insurance benefits of $300 per week have been extended through September 6th. And in addition, another benefit for those that are unemployed, the first $10,200 in unemployment benefits will be tax-free under this act. So again, a big benefit to those that have been hurt by the COVID environment.
So Dan, clearly it's really early, but do you think the plan is working, and if so, for whom?
I definitely think the plan is working. We've pumped so much stimulus into this economy. For example, 159 million direct stimulus payments have been delivered, totaling $378 billion. That's just an example of some of the many stimulus actions that have been taken. So to quote and get a little bit into Jason's area here, 9.8% retail sales in March. They had expected 5.5%, so almost double. And that was after a 3% drop in February. And that was, again, attributed to the $1,400 stimulus checks and vaccinations. So overall, in polling, 85% of Americans say that their financial circumstances are either the same, 50%, or better, 35%, than they were pre-COVID. That leaves 15% of the population saying they're worse off, and that's generally at the lower income level. So again, it depends on the demographic, as always, and the sector that's been affected. But overall, with 85% saying that they're at the same level or better off than they were pre-COVID, I'd say it's working.
Yeah. Okay. Very good. Thanks, Dan. Jason, what's your take on the current stimulus package?
Yeah, I'd largely agree with Dan's comments. It's working. Dan mentioned the retail sales growth we saw in March, second highest month for retail sales growth ever in the post-World War II period. The highest was actually last May when we unlocked the economy and let people back into stores. But as long as we continue to support the unemployed, support those that have been economically left behind by the pandemic through primarily unemployment support, but also some of those state and local funding plans, and critically the business lending portions of the most recent stimulus package were very important. Extensions of the PPP program, restaurant support, those things are very necessary to get us over the hump to the point where consumers are fully back in the marketplace. We do have to be mindful of the inflationary pressure that all of these dollars create for the economy. It's important to note, if we inflation adjust it and compare to our size of our total economy, our gross national product, we're still not quite to the level of deployment that we saw with the reaction to the Great Depression and the New Deal from the 1930s. So on a percentage basis, even though it's well north of $5 trillion at this point, we're not quite to the point of the size of the economy in terms of support that we deployed during the 1930s.
Guys, the numbers are staggering. But to your point, Jason, we've certainly seen a lot of our commercial customers at Wintrust benefit from these programs. So good news on that front. Okay, so while the American Rescue Plan is playing out, there actually are additional stimulus packages on the table. The proposed $2.3 trillion American Jobs Plan, as well as the Made in America tax plan. So Dan, what are these plans intended to accomplish?
Well, we'll put up the slide here and we'll see what's in the Americans Jobs Plan. The Americans Jobs Plan is really proposed to include investments in infrastructure, research, and support for manufacturing. And you can see in front of you where what the priorities are as part of this plan. The Made in America tax plan, which we'll talk about in a minute, is really the pay for this infrastructure plan. And that is, and we'll see in a minute that where that's focused and where the tax money is going to come from that pays for this plan.
Okay, so Dan, in terms of distribution of proposed proceeds of the American Jobs Plan, who might benefit and how long do you think it would take to produce results here?
Well, this plan won't kick in, Tom, really for another 2 years. This is a long-term plan in infrastructure that'll really develop over 8 years following that. So both the tax hikes that are in the Made in America tax plan, those are also staggered over a period of years to match the American Jobs Plan. So this is a long-term spend and a long-term pay for that'll develop over time. It won't just happen tomorrow.
Got it. And Jason, what's your view on this proposal?
I think it's important to understand, as Dan pointed out, this is not another immediate stimulus proposal. It's a benefit to growth over the next 10 years, really, and deployed in waves from 2 years out to 10 years. It's also important to understand this is the Biden climate bill. The Dems were handed a bit of a blue ripple at the election in a virtual tie in the Senate. That doesn't create a overwhelming Senate majority and the avenue to create more progressive environmental plans. So the definition of infrastructure here is pretty broad. They fit in a number of things next to bridge and road repair. It's also buying electric postal vans and billions in environmental and social infrastructure that are generally left out of the traditional definition of infrastructure. Those are all important things. The other thing to understand with an infrastructure spending bill, impact is also delayed. So this is likely not going to cause immediate inflationary pressure in the economy. We're going to see 2 to 2.5 times the economic impact of the dollars spent in this bill, but those impacts are staggered from 1 to 5 years after those dollars are deployed into those infrastructure projects to begin with. So this is fueling American growth potentially for more than a decade, if properly deployed and if we get some agreement across the two sides of the aisle.
Great, thanks, Jason. Yeah, so maybe not immediate impact, but big dollars, a massive spend here. How, Dan, would this be funded?
Tom, this plan, the American Tax Plan, is really going to targeted tax increases on corporations. It's a proposal to raise corporate tax rates, especially targeting multinationals, as you can see on the screen here, raising corporate tax rate to 25% from the current 21%. Many of you will recall from our prior quarterly sessions that the Biden proposal really was 28%, but on Monday of this week, it was reported that Democratic leadership in both the House and the Senate now will agree with Senator Joe Manchin of West Virginia that we shouldn't go above 25. So that's why you see the 25% number here, not 28. There are some significant increases in tax for U.S. multinationals as well. And just to quantify these, and the way that the government quantified it is over a 15-year period. So you can see the long-term tail on both the spend and the income generated. The income tax increase on corporations up to 25% would generate $600 billion over a 15-year period. And the increase on taxes on foreign earnings on multinationals going from 10.5% to 21% would generate another $700 billion, again, over that 15-year period. So here, this is the pay for on the infrastructure bill over a long period of time.
Yeah, so Dan, as you say, you have kind of two proposals, one being the spending proposal, the other being the pay for the taxes. Will these be presented as a package in Washington?
You know, it is a cause and effect, clearly, and one would think that they will. They will present it as a package. I cannot tell you for sure. These things changing by the day. For example, the timing of it, President Biden had said that his goal, 2 weeks ago, he said his goal was to get a written bill submitted by Memorial Day. Nancy Pelosi came out later that same day and said, no, I don't think it's going to be Memorial Day. We're going to be after Memorial Day. So we'll probably see something in June submitted. It probably will be a single act. And just this morning, we have a third act that may be combined with it. I want to mention it also has the word American in it. So we have a theme here. And in two reports, I've seen it referred to in two different spellings. It's either the American Families Plan or the American Family Plan. I've seen it on different news services reported it in different ways. So again, it hasn't been articulated yet. That's supposed to come out next week. So stay tuned. Biden will roll out that plan next week. And that's his human infrastructure plan. Now, in the infrastructure plan we just talked about, the American Jobs Plan, that was infrastructure, hard asset infrastructure in our country. This is going to be presented as a human infrastructure plan with spending on childcare, expanded childcare credits for parents, free community college tuition for all. So stay tuned next week. That should be rolled out.
Okay. So Dan, sticking to the first two plans, so the infrastructure proposal as well as the kind of let's call it the corporate tax plan, the pay for, as currently constructed, what is the likelihood of these passing?
Well, passing as they have currently been presented, I'd say there's zero chance, right? We've already talked about how the corporate rate is that they will settle on is most likely 25%, not 28%. That has been articulated all along by the White House. So we've already seen a big change there. That was influenced by centrist Democrats like Senator Joe Manchin. In addition to that, we've already seen another major change in the original Biden proposals. That has to do with the minimum tax on corporations. Originally, it was supposed to be a 15% minimum tax on book income for corporations with over 100 million in book income. That would have affected 1,100 companies in America. That has since been changed, revised by and discussed by President Biden. He's going to change that from 100 million threshold to 2 billion threshold. And the companies affected by that will now change and go down from 1,100 companies to only 180 companies. But it's going to be the 180 biggest companies in America. And to use Amazon example, if you run this new minimum tax through Amazon's numbers from 2019, they would have paid an additional $1.3 billion in tax in 2019 from this one change. So again, it's in flux. There are changes that are happening almost every day. New proposals coming out almost every day. So we'll see what happens at the end of May, early June, and what gets presented in the bill when it gets written.
Okay. Thanks, Dan. I'm actually going to jump ahead a little bit and turn our view towards the future. And before we do that, let's start with our second question to the audience. Our polling question number 2, if you could pull that up, Paul, that would be great. Yeah, so our question is, what do you see as the number one risk to the economy in the next 12 to 18 months? And we've got 4 options there: resurgence of the virus, higher than expected levels of inflation, increased corporate and individual taxes, or the catch-all something else. So take a moment, please, and answer that one, and we'll come back to it in a minute. Okay. All right, so Jason, before we reveal the results of the polling question, what is your view on the overall economic outlook, and what risks do you see to the current recovery?
Well, like we talked about at the beginning of our time together today, the full year forecast for US GDP has been raised significantly higher. It's based on a faster vaccine rollout. A stronger jobs recovery is expected as we move in towards the end of the year. Inflation poses a bit of a risk to that continued expansion, but I mentioned the size of the spending that we've seen this go around compared to what we saw in the Great Depression. And yes, it's a lot of money, but it may not be as big a percentage of GNP. However, a recent poll, and for those of you still entering your results, no fair cheating if you're going to follow the professional money managers, a recent poll of professional money managers that is done every month. For the first time in 13 months, COVID is not the number one concern on professional money managers' minds, it's inflation. Keeping that in mind, it really boils down, though, to the rate of acceleration in inflation that matters more than the absolute level right now. It's an idea postulated by Austin Goolsbee at the University of Chicago, backed up by a couple of economists at Harvard, and they really look at the compare and contrast against 10 years of subtrend inflation that we've experienced running up to 2020, and the ability of the economy to exist at 3+% inflation, even for several years. A rapid rise in inflation, though, to 1970s type levels, even 3 stair steps or 1, that would threaten the economy. Where a gradual rise and these base effects we talked about, persistent 3+% inflation, that's not a worry. That's actually catching us up on a price inflation basis to where we should have been over the course of the last decade. Indications are we're going to see a steep yield curve persist into 2022. The Fed's going to stay parked on the short end of that curve. The long end will likely continue to steepen further towards year end. I think we would expect a 10-year yield on the 10-year Treasury to close the year somewhere between 2 and 2.25%, with an outside risk of 2.5 to 3% if inflation accelerates a little faster than anticipated. That would not be outside the realm of possibility, nor would it be economically destabilizing to see the yield curve move that significantly.
Okay, good. And I think it's the right time to shift our discussion towards the markets. But before we do, let's just check the results real quick of our second polling question. Paul, if you could bring that up, let's see what our audience thought was the number one risk. Very close. The virus, inflation, it looks like inflation just edged it out there at 31% of the votes, but taxes are worrisome and maybe something else. So it's pretty balanced. But Jason, I think maybe some people read ahead on your answer about the other economists' risk of inflation. So let's look at where things are likely headed from a market perspective, Jason, and where we may see pockets of strength and weaknesses in the markets in the year ahead.
Okay, and starting there actually starts with a 2020 hindsight look at 2020, and large cap growth stocks, particularly those in the technology and communication services sectors, saw the bulk of the gains for most of 2020. Think those work from home stocks, think about Netflix, think about Amazon. In fact, approximately 10 companies really drove S&P 500 index performance up until the late third quarter of last year. As the recovery began to take shape, though, more typical market performance pattern for a recovery started to emerge. Small cap stocks did better, value stocks did better. And that's what we've been seeing for the past several months. Those smaller stocks, value stocks, out of favor sectors from 2020 have become the market leaders of 2021. In terms of pockets of potential weakness, those overheated growth or tech stocks, and we've seen this in pockets as we get good news about the recovery, those growth stocks, particularly the work from home ones, start to see a little bit of valuation oriented pressure downwards. We'll see that weakness persist for a few months. The investment grade bond market right now doesn't look like a great place to be if you're an investor in the Barclays Aggregate Bond Index. It's not really a robust investment option to sit there and get paid yields like we're seeing across the Treasury spectrum when inflation is going to trend north of 2.5%. You're getting paid actually negative real returns there to stay put, and next to nothing in nominal terms to boot. In terms of areas of opportunity, there's likely still maybe some room to grow in a few places, but let me know if you want me to touch on that in any further detail there, Tom.
Yeah, I mean, I think our audience would love to hear if you have some insights as to opportunities for investment. It seems that those are the questions we always get. What should we be buying? So I think you could go a little deeper here, Jason.
All right, will do. Well, that valuation gap between growth stocks and value stocks reached its historic widest point in 2020. Even with some of the performance that we've seen from value and smaller cap stocks, closing a significant chunk of that over the last 5 months, there's still likely room for outperformance in those names as the spending power of the American consumer comes back to the market, particularly in those areas that have been unloved to date. We're likely to see more positive returns from those value-oriented stocks and sectors than we are from the growth end of the spectrum. That includes international and emerging market stocks. The international indexes, international stocks generally, particularly throughout the developed world, have a lot more financial services, industrials companies than they do technology companies. So international stocks have a higher propensity to outperform US stocks on a large cap basis in the coming years. And emerging market stocks, they were kind of left behind in all the market turmoil. And once we get past 2021, the emerging markets really should resume their leadership position for global growth. A large percentage of global GDP growth actually comes out of the emerging markets, out of China and India, Southeast Asia, Latin America. Those countries, once they get their handle on the virus, they get vaccines rolled out, and they start catching up to the United States in 2022 and 2023, look like attractive areas, particularly at the current level of valuations. The last one I'll mention is infrastructure. It's intriguing as the American Jobs Plan works towards passage. Just reminding everyone that this definition of infrastructure is broader than the traditional definition of infrastructure in this plan. That means things that are outside of that, particularly those in the environmental and social governance areas of the market. ESG is an attractive area, and it's Earth Day. So I'd be remiss if I didn't mention the capabilities of the market as it relates to ESG investing on Earth Day. But that is an attractive area for us on a go forward as well. Infrastructure, and more specifically, those ESG areas in the market could be market leaders in the years and decades to come, to be frank.
Yeah. And a little plug for us. So Jason mentioned ESG. We've got a tremendous set of experienced investors in the ESG space. We've been doing this for decades. And if you're interested, we've got some folks that can talk to you and help you through those types of investments. Jason, one other quick thing. You did mention that, concerns about the bond market. I might say that the conditions are becoming more favorable for municipal bonds right now, as interest rates have moved a little higher, providing some yield finally. Personal income tax rates, Dan will talk about, are likely going to be increased. State and local governments are being funded and supported now by stimulus dollars. So there's more help on the credit side. Would you agree that these are all helpful factors for municipal bonds?
I'd agree wholeheartedly. As an individual investor, a portion of your portfolio always needs to be that safe ballast, that safer risk allocation. And municipal bonds represent a great way to do that right now. Tom, as you mentioned, attractive on an after-tax basis. State and local governments are being well funded through the stimulus program. So any fears of localized defaults or things like that have ebbed largely away. Market liquidity is robust there in the municipal market to an extent. And it makes a lot of sense, particularly for higher net worth investors, to be invested in municipal bonds and get the after-tax benefits that they would represent to your portfolios.
Yeah, agreed. Okay, so let's wrap up with a summary of what all this means for investors and business owners. So Dan, what's your message to business owners in terms of things to be prepared for in the context of our discussion today?
Well, Tom, I'll just say two things. Number one, we're in a rising rate environment, both for individuals and businesses, but specifically for businesses, I just said we're most likely going to go to a 25% tax rate from 21. And pass-through entities, we haven't really talked about that, but I'm going to answer one of our chat questions at the same time right here. Obviously, for pass-through entities, they will also be impacted by future law changes. The 20% pass-through deduction for that will flow through to individuals making more than $400,000 a year will go away. So whether you're a pass-through or a C Corp, to answer our question, in the chat, taxes are going up. And we've talked in prior sessions about what I call bracket management. And at time, there are strategies to use when you're crossing years of where either rates are going up or going down. It's bracket management. The second point I want to make for business owners is capital gains. We saw today an announcement. Thanks for Mary Cunningham for asking your question in the chat room. Yes, I did see that today. we talked about it before we went on live here this afternoon. Is the 39.6% rate realistic for those making over $1 million? What that would mean is if you sold your family business, your family farm, you're now paying a 39.6% rate plus 3.8% net investment income tax that was in the press release today. Yes, your taxes would double from a 20% capital gains rate today to, if this is enacted effective in 22, effectively double that and going up to close to 40% plus 3.8. So yes, you should be seeing some activity as this rolls out for the rest of the year. And obviously it takes a long time to sell your company. If you're otherwise inclined to pursue an exit strategy, for the rest of 2021, now would be a good time to get the wheels in motion to do that. So that's some of the advice that I would give a business owner. Great,
thanks, Dan. Good advice, Jason. How about from an investor's perspective? What should they consider in light of what we talked about today?
A couple good considerations on the investment side. Number one, look past short-term volatility. I'll point you back to the mid first quarter reaction to the inflation panic and destabilization in rates, and the year-to-date results for those who stayed put and were invested. If you panicked in mid-February when inflation started to become a fear and moved off to the sidelines, you missed a significant amount of the return in the first quarter. It's entirely probable that we will see these inflation jitters repeat in the spring as those base effects roll out and those headline numbers come in at larger numbers than we've seen in a couple decades for inflation, but also as we move through the rest of the year. If the vaccine rollouts continue to be strong and Americans continue to spend as they've spent, it's hard to tell when that spending is really hit until we're looking at those retail sales numbers 3 weeks after the end of the month in which they occurred. But that economic benefit's already out there. That price impact is already out there. And then inflationary pressure is. So you don't want to miss the bounce from those positive economic developments. Timing the market in 2021 in particular is a losing proposition. You also want to make sure the portfolio is diversified. For those of you that pay attention to the trailing one-year performance of the market, rolling out all of the troubles of March of last year and looking at month-end to month-end performance, equity markets are up more than 52% on a trailing one-year basis. Now is a great time to take gains, particularly with this proposed tax changes in names that have appreciated significantly, especially those that are significantly overvalued in the large cap and growth arena. Lock in those gains. Don't lose them to a correction. Don't lose them because of a fear of paying taxes today. You'll hold them, you'll pay more taxes later, and you'll have less gains. So this is an opportune time to rebalance. And in fact, in our multi-asset portfolios, over the course of the last week, we have been strategically rebalancing those portfolios to take advantage of the gains, lock those in, and reset the risk perspective of the portfolio. Work with your financial advisor, your financial professional on a long-term financial plan. And I've always found that periods of high risk, like we have just come out of, are great times to reevaluate that plan. We can all answer those risk questions easily if we're in year 8 of a bull market. But if we're coming out of a bear market and we've seen the experience of what risk in the markets really means, it's a good time to reevaluate. Am I comfortable with this amount of risk or not? And if you're not, it's a good time to evaluate that financial plan and make some changes as you rebalance.
Yeah, great, Jason. Great advice. And I want to take a couple of audience questions. But Dan, just before we leave that, Jason mentioned capital gains, and do you have any closing thoughts with respect to some estate planning tactics that people should consider?
Yeah, Tom, I'll just mention one, and we'll turn it over to you for Q&A. Estate planning. The estate tax rates are going to go up, and they're going to go up most likely in 2022 on January 1st. You have an $11.7 million lifetime exclusion right now that won't be taxed upon your death or on gifting. That's going to go away. That's going to drop down, most likely to 3.5 million. So work on your estate plan immediately. And there's even more cause, and I'll just add this too. 2 weeks ago, Senator Bernie Sanders came out with this for the 99.5% Act. When I talk about effective dates, there are effective dates within that act that are sooner than January 1st, 2022. All along, we've been saying most likely they'll be effective next year. Well, if you're going to work on a grantor trust, if you're going to do a valuation discount for a family limited partnership, a number of other strategies, those are going to change and go away on the day the president signs the act. And if that happens on September 1st, that happens on September 1st and the law has changed. So be aware that we may not have until January 1st to do all the planning that we want to do. We really need to do it this summer before the act passes, if these effective dates are true.
Yeah, good. Again, also good advice. So get after your estate plans. We don't know how much time you may have before things change, and we're here to help you do that. I'm going to try and get to at least a couple of these questions. Let's see, Alan Mothershed asked about the Fed, Jason, and we know that inflation was one of the primary risks that our audience was concerned about. Do you believe the Fed has effective tools to manage potential inflation? Jason, I'll turn that to you.
I think the Fed has a couple key benefits in managing inflation. One, we have real world experience for what the Fed did in and coming out of the 1970s in terms of reacting to an inflationary environment. So they've got experiential learning. Two, there's a decent set of tools available to the Federal Reserve, either in terms of short-term rates or in terms of the current quantitative easing or bond buying programs that are in effect. I think the canary in the coal mine for us is going to be those monthly bond purchases. When the Fed starts to taper those, we're going to start to worry about rates coming up. That's the next set of tools they've got to increase. And those have proven to be effective enough tools in the past. The one thing it's not effective at is engineering a soft landing. But I think by this point, most of us do not expect the Fed to be capable of engineering the soft landing they always tend to promise. So at some point, years down the road, when we start to see rates come up significantly, I think we prepare ourselves for a return not to an event-driven recession, but one that's more cyclically driven, and that's something that's way out over the horizon line for me at this point.
Got it. Thanks, Jason. You know, one from Paul Salt was about the China-U.S. sort of trade situation, and I know you follow that closely, and things have changed from the prior administration till now. Can you just give us your perspective on where we are there and what you see ahead in terms of relations between the U.S. and China on trade?
Sure. This was our most popular topic as it related to question and answers before the pandemic. What's going on with trade with China, the ongoing trade war? The Trump administration had put together a phase one deal with China a year ago. That has proceeded probably as expected. In effect, China had agreed to buy a certain amount of U.S. goods as imports. They bought about 60% of what was expected. That's about all that any of us probably really expected them to do. Pretty aggressive goals in that phase one deal. The Biden administration's trade representative was just confirmed at the end of March by Congress. A lot of questions in that confirmation hearing around a phase two deal. And I think that's going to be an area of focus. The clear answer from the Biden trade representative is we want to work with our trade partners, and that's a good thing. Individually, we don't have a lot of leverage from an economic perspective over China. They've got a lot more economic leverage over us in those trade negotiations. We make it a multi-party negotiation, though, and include countries that are economically meaningful to Chinese exports and imports. Some of those allies like Australia, like Europe, we can start to exert a little bit of even behind the scenes economic pressure and get a better phase two deal completed. And I think the clear message from the business community is we need a phase two deal, and we need the phase two deal that addresses some of the big ticket items. And I think in the coming years, we'll see a lot of talk about that coming months, and we'll work towards a phase two deal. That's the real solution to China.
Excellent. Okay, thanks, Jason. And we do have some more questions. I unfortunately, we're over time already, so I'm going to have to cut that off. I see a couple of them around Bitcoin and cryptocurrency, so we promise to get to you guys next time on that. Keep them coming. But that's all the time that we have for today. Really appreciate everyone joining us. As we noted previously, we'll be conducting these panel discussions quarterly, and our next session will be in July. In the meantime, you can follow Jason Turner's Thinking on the Economy by reading his weekly market update, which you can see by following Wintrust Wealth Management on LinkedIn or requesting your Wintrust Relationship Manager to send you a weekly email on with the market update. And Dan Rahill's published articles on legislative changes and their impact on business owners and investors can also be found on our website, wintrustwealth.com, under the guidance section. Finally, a recording of today's event will be available on Wintrust YouTube channel, as will a transcript on our website. So I thank everybody again. We ask you to stay safe and have a great rest of the week. Thank you.